Hi there. Dividend taxes are rising in 2026, but high earners are already using ISA transfers to protect their income. In this video, I'll explain exactly how this legal strategy works.
There's a major tax change coming for UK investors and business owners, and honestly, the deadline is getting closer than you think. Understanding how to get ready for it now could make a massive, and I do mean massive, difference to your wealth down the line.
Let's just start with a number, shall we? £990. Come 2026, that could be the extra tax a higher rate taxpayer is forking over on £50,000 of dividend income every single year. It's basically a permanent pay cut, unless you do something about it.
Now, before we get into the nuts and bolts, I want to make it super clear. Everything we're about to go through, the numbers, the strategies, the warnings, it all comes directly from the expert tax advisors at one of the UK's most trusted firms, My Tax Accountant. They've put this analysis together for this very reason, to help people like you get ahead of these changes.
Okay, so here's how we're going to break this all down. First, we'll look at the problem itself, the 2026 dividend squeeze. Then we'll see what that actually means for your wallet. After that, we'll get into the best solution, how to actually do it, and even some clever tactics for those who want to go that extra mile. Sound good? Right, let's get into it.
Right, so let's properly unpack this challenge. The changes that are going to hit in April 2026 haven't just appeared out of the blue. They're really the final move in a long game that's been squeezing investors and company directors for the best part of 10 years. This is a very deliberate long-term policy shift.
And this timeline, well, it tells a pretty stark story, doesn't it? If you wind the clock back to 2016, you could take home £5,000 in dividends completely tax-free. That was a decent chunk of change. But fast forward to now, and that allowance has been chipped away again and again until it's just 500 quid. That tax-free buffer, it's pretty much gone.
And here's the kicker. It's a double whammy. From April 6, 2026, the tax rates themselves are jumping up by a full 2 percentage points. That's for both basic and higher rate taxpayers. So not only is more of your dividend income going to be taxable, but you'll be paying a higher rate on it too. This is a detail that catches a lot of people out. So, what on earth does all this mean for your bank account? Theory is one thing, but let's make this simple and look at a real-world example to see how this all plays out in pounds and pence. This is where it gets real.
Let's imagine someone, we'll call her Sarah. She runs a successful consultancy up in Manchester. And like a lot of directors, she takes a small salary and then draws a £50,000 dividend from her company's profits each year. This puts her firmly in the higher rate tax band.
Right now, her tax bill on that £50,000 dividend is just over £16,700. But from April 2026, on that exact same dividend, her tax bill is going to shoot up to nearly £17,700. That's a massive jump, and she hasn't earned a penny more.
And there's that number again, £990. That's the extra she's losing to tax every single year. This isn't a one-off hit. It's a permanent dent in her take-home pay, unless she changes how she holds her investments. It's a fundamental shift in her finances.
This isn't happening by accident, you know. It's all part of a bigger government strategy. For a long time, there was a clear tax advantage to operating as a company director. But as dividend tax and corporation tax have gone up, that advantage has been seriously eroded. They're closing the gap. So, with all this pressure building on your income, what's the best line of defense? Let's get to the solution. And you'll want to hear this, because there's a powerful, government-approved tool that can shield your hard-earned money from this tax hike.
It's the Individual Savings Account, or ISA. And honestly, the best way to think of it is like a tax-proof fortress for your money. You put your investments inside this protective wrapper, and any dividends they pay out or any growth they make is completely shielded from tax. It's all yours to keep, well away from HMRC.
Now, here's the crucial bit. Every single tax year, you get a £20,000 allowance to move your money into this shelter. But, and this is so important, it's a use it or lose it deal. If you don't use your full allowance by the 5th of April deadline, that year's allowance is just gone, forever. You can't carry it forward.
Okay, that's great for new money, but I bet you're thinking, what about the investments I already have sitting outside an ISA? That's a common problem, so listen closely, because there's a specific, well-established process for migrating those assets into the tax-free zone.
It's called the bed and ISA process, and it's basically a 4-step maneuver. Step 1, you sell your shares or funds in your normal taxable account. Step 2, that sale creates a capital gain and you can use your annual exemption to wipe out some or all of the tax. Step 3, you move the cash from the sale over to your ISA. And step 4, you immediately buy back the exact same investments, but now they're safe and sound inside the tax-free wrapper.
And here is a huge tip from the experts at My Tax Accountant. Whatever you do, do not leave this until the last minute. Every single year, without fail, the investment platforms get absolutely swamped with requests in that final week of the tax year. These transfers take time, and leaving it to the 11th hour is a simple but very, very costly mistake to make.
Now, this is the part that catches so many people out. There's this rule, right? Usually, if you sell an asset and buy it back within 30 days just to create a tax loss, HMRC sees that as bed and breakfasting and they'll nullify the benefit. But, and this is the key, the bed and ISA process is a specific HMRC-recognized exception to that rule. It means you can sell and then rebuy straight away inside the ISA and the tax benefits are totally locked in.
The ISA is your primary tool, but you can actually combine it with other strategies to build an even more robust plan. And stay with me here, because this next point is a real game changer if you're a couple.
Right, if you're married or in a civil partnership, you can basically double your firepower. You can transfer assets over to your spouse, and there's no capital gains tax to pay on that transfer. This means you can use their £20,000 ISA allowance and their capital gains allowance too. Put it all together, and as a couple, you can shelter up to £40,000 of capital every single year.
So a lot of people then ask, well, what about my pension? It's a great question. A SIP, or a pension, is brilliant because you get that fantastic tax relief on the money you put in. The trade-off is that the money is locked away until you're older and it's taxed as income on the way out. An ISA is the complete opposite. No tax break on the way in, but every single penny you take out is 100% tax-free, and you can get to it whenever you like. They do different jobs, but they work together perfectly.
So we'll leave you with this one final thought. The rules of the game are changing, and that 2026 deadline is set in stone. In this new world, it's not just about earning a return on your money. It's about how much of that return you actually get to keep. Is your wealth really structured in the most efficient way to win that battle?
Okay, and before we finish up, it is really important to say that this has all been general guidance to get you thinking. Everyone's financial situation is unique, and tax rules are complicated and they do change. So what's right for one person might not be right for you. And that's exactly why we always recommend you get professional advice that's tailored to your specific circumstances before making any decisions. The expert team at My Tax Accountant, who put all of this information together, are on hand to help. You can call them on 0208-570-8531 or send an email to info@mytaxaccountant.co.uk. And for more insights like this, make sure you subscribe to the My Tax Accountant YouTube channel. Thank you so much for watching.